Just looking at your Investec cautious managed fund, the size we're looking at is 3.5 billion rand, inception 1st of April 2006, and you are very defensively positioned. And of course, equity markets have run relatively hard of late, so that has somewhat impacted your performance relative to other funds in the same class in the short term.
I would say that the first thing is that this fund is slightly different to other funds I manage. It really has a risk budget, as we call it, of 40%. So equities as an asset class, I can only really go to a maximum of 40% in equities. I am able to go offshore, but there I'm obviously confined to the 25% maximum in terms of the regulation. So if I'm bullish on offshore equities, I can go to 25, and then I have 15% to play with in domestic. And as for the rest, it's fixed income securities, which means that in principle, the fixed income component of the fund dampens the volatility, and then you really, you're playing in terms of risk. You're trying to expose the fund to risk at 40%, and it's a function, obviously, of market conditions. But overall, by structure and by design, the fund is in fact conservative. So you can get my views on asset classes, but the fund itself, I think, is a very conservative, balanced fund.
Sam, just two quick questions from my side. One's more
Sure.
of a technical question. What is the benchmark in the fund?
Well, yeah, thanks, Wayne. The benchmark, in truth, it's more of an absolute return type fund, and I would argue that through the cycle, Wayne, investors should really be expecting a return of cash plus or inflation plus. And I think the best case scenario is inflation plus 3, and that's a great outcome.
Yeah.
So I would argue, given your risk budget, that really you shouldn't be aiming to beat inflation by much. That is probably the true benchmark. But in truth, because we're playing in a sector where there are over 60 funds and there are a lot of other funds, it is fair to say that investors have a choice in terms of the strategy. Therefore, an additional benchmark is the average fund in the sector.
Yep.
So I've given you a long answer to, and the short is there are probably 3 benchmarks: cash plus, inflation plus, and the average fund.
Well,
and you can take your pick, which means that it's really tough. But I know that you'd understand that how tough that can be.
We've all got 3 targets to beat in investments at any stage.
Yeah, I know. If there's anyone who'd understand, it would be you. You had another question, Wayne?
Yeah, when you look at your fund, you fully invested offshore, is that right? Of which you've got 15 in equity and another 10 in cash. How do you see you deploying that other 10% in global cash? And maybe the best way to say is, what's your view on the rand, number one, and secondly on global shares versus domestic shares?
All right. I think that if you look through it, Wayne and Bronwyn, I think, and to all the listeners, I think the underlying view that I've had, and this has been for a while now, for the last 12 months, has been that I can find relatively better value offshore than locally. Now, the reason I use the word relative is I'm not really completely negative on the domestic equity market, but on balance, I have found slightly better value in global equities and a certain type of equity. I presented in the past on a fund called the Global Franchise Fund, which is really quality and defensive equities globally. Now, my feeling is that apart from that, I've generally felt that even globally, the very same things that's happening in the South African market's happening globally. The market, I would say, is marginally overvalued across the board. So certainly I'm looking for places to hide in equities, and in this fund I have a small equity risk budget. The cash that I have there, Wayne, is because I have felt that the rand is relatively strong, and that certainly in the shorter term, the stronger rand means that I'm able to benefit from that. The cash that I own doesn't give me much in yield, as we all know, but it effectively is me trying to position for a potential weakness in the currency on the basis that my overall view is defensive, and that when risk aversion happens, typically emerging market debt and our currencies typically sell off, and the dollar, for temporary reasons, becomes quite strong. So it's more of a tactical position, and I certainly don't want to go on air saying that I know exactly where the rand will be, Wayne. I think that my feeling is that I want to be maximum weight offshore, and the fact that my equities are not full tells you that I'm even worried about global equities a little bit more, but in overall, but probably not as much as I do domestic equities.
Sam,
I don't know, does that answer your question?
Yeah.
He seems very happy with
Yeah,
that, Sam.
very happy.
Just touching on your top 10 holdings, and perhaps
Sure.
your stance on risk aversion is highlighted by the fact that in your top 10 holdings, you've got New Gold at number 1, and then exposure to Harmony Gold Mining and Goldfields. Now, that, of course, is quite a controversial stance when it comes to the gold miners. But first of all, let's touch on New Gold and your exposure on that front.
Yeah, I think, whenever a fund manager goes on air and you start talking about your views, it's always very difficult because, we know that this is a dynamic and volatile environment. Share prices, asset classes, things change so quickly nowadays that, I could leave this room and in 2 days, the market changes and my expression of a view could change. I will say that this has historically been my view that what I really want is, in terms of risk aversion, I'm very concerned about paper currencies. And my feeling is that gold is effectively a currency and my currency of choice. I've already mentioned that I have a feeling that the rand is very strong of late. So I'm looking for exposure to both gold and rand weakness. And the best way I can do that is effectively via New Gold. And then gold is also a safe haven in times of stress. So when you put it all together, I generally have a view that QE2 was reckless and that at some point the exit of QE2 will cause some sort of risk aversion and rotation into defensive names, which is why I've historically held this position. So once again, it's a position that I've held for a while. Of course, the question is what will happen now? And I'll be honest, I'm astounded at the resilience of the market. I think that anyone that's in the industry will say, well, it's almost as though the market is expecting another stimulus package and pricing it in, Whether that be QE3, QE4, who knows? I mean, there's no one in the world that can tell you what will happen, but it's clear that the market has been very resilient, which means that if they were to announce QE3 tomorrow, then quite honestly, Bronwyn, the portfolio has to change. This tells you where I am today. I'm very happy with the portfolio as it stands. But, we don't know how the world will play itself out. And if we've learned anything, is that, with the announcement of QE2, even if you disagreed with QE2, like I have, even if you felt that it would be high on rhetoric, a lot of talking, and low on economic delivery, you might have been right, but you've been 100% wrong in terms of the way risk assets have repriced. So I would say that I've learned a lot through this period, and my feeling is that I'll watch policy and the way it's executed, and I'll change the portfolio accordingly. But for now, I'm happy with the very defensive
Sam,
stance.
just focusing on Goldfields and Harmony. Now, the detractors to the gold mining story in South Africa are numerous. There are a number of people out there who don't like this story, the deep level mining, the rising input costs. They can't capitalize on the higher gold price. Very quickly, sir, your response to those detractors.
Yeah. So firstly, I think I've given my view on the rand gold price via New Gold. I would say that typically gold equity should lag, and there are very good reasons, and you've already expounded on that. I would say that the gap between gold equity and the rand gold price being the driver is extraordinarily big right now. And my feeling has been that in the absence of other parts of the equity market, I am very happy to own it. And there are other parts of the market I think that have been more extended. But interestingly enough, if you look at platinum today, a lot of the platinum stocks have sold up so much that gold equity might not be as relatively attractive, as it's been in the past. So, as always, these things can change as we go forward. But gold equity still has a place in my mind. And I have to admit, I enjoy the fact that nobody agrees with this particular view. So
Sam,
that's normally part of what I like to do, on the basis that occasionally there are some returns just by being different. Yeah. But for me, the lag between gold equity and the rand gold price is just too wide. And it's certainly worth having in a defensive portfolio.
Sam, when you look at your fund and you look at the underlying shares, you've spoken about the New Gold and we've spoken about the gold shares. The other shares in your portfolio, there's no real, let's call it China focus for want of a better word. Is that obviously that's intentional? And then what's your view on that?
Yeah, you were well spotted, Wayne. It's exactly that. I think that my concerns generally relate to high expectations in terms of Chinese demand, the Chinese growth, and elevated metal prices, particularly base metal prices. And my feeling has been that I've been trying as much as possible to steer clear from very high expectations there. In the shorter term, it has probably not worked as well, and certainly the latter part of last year it worked badly, but it is an intentional positioning on my part. I have to say, though, that Anglo-American is slightly different in that over time, Anglo-American has been a stock that we've been able to benefit from. But well spotted, Wayne, I'm very concerned about that. My feelings on China is that I think, that China, quite bluntly, I wouldn't be surprised if there's a string of negative surprises from China over time. And I'm not an economist. My feeling is that I think that expectations are incredibly elevated. And even though they might be high in absolute terms, Wayne, with very high inflation that seems to be rearing its head, my feeling is that while the absolute number in terms of growth might be high, it might be very low relative to expectations, which might have a knock-on effect. So I'm very happy with that particular positioning. And yes, it's very anti-China, but I'm never really thematic. But it is true that the stocks have been picked on that basis.
Sam, you've highlighted the fact that you like to take a contrarian stance.
That's
just
right.
Looking at Sasol, we were discussing the stock earlier, and in fact Wayne pointed out that this is one of the most widely held stocks across all portfolios, specifically where South African fund managers are concerned. Is the story just too good here that you couldn't go contrarian?
Yes, I think part of the contrarianism, I think probably the toughest thing for a fund manager is, that you have to really, really guard against hubris or arrogance. And I think that being contrarian is worth doing, but you have to be right, and in some cases the fundamental stories are so good, or there is no particular edge or angle that you can extract that means that you have to go against the market. And I think in the particular case of Sasol, is that over time Sasol has been weaker, and probably the earnings. When we talk about the market being high, I always look at the level of earnings. And my feeling is that I'm very happy to pay a higher P than the market, provided the level of earnings are not extended. And if you compare Billiton versus Sasol, it's pretty clear to me that the level of earnings are probably not as high in Sasol. So I think being contrarian here would be incredibly brave, even though it might work out. So, I think you have to pick your spots, and this is not one of them.
Sam, thanks so much. It's always a pleasure, sir. Sam Houlie from Investec Asset Management.